We are going to look in this session at the importance of acceptance and continuation of client relationships. So we're not looking at a specific aspect of the engagement. We're looking at who do we accept as clients. So you might ask, why is this important? I don't think it's really necessary to answer that question in the context of South Africa at the moment, and even worldwide. We have seen with some expensive lessons that some auditors have learned that it's very important that we pay careful attention to who we accept as clients, and even our existing clients, that we make sure that when there are red flags or things that concern you or concern our colleagues, things in the papers, that we have to look very carefully at whether we need to stay involved with this client. That is a very important aspect of your quality control. If you can have systems in place to ensure that you only have clients that are serious about reporting, that know what they're doing, that have the necessary integrity, and the clients that we can service, then you can rest assured that your quality, the rest of the quality management process will take care of the rest. Another quote that I've got on the screen here is, in terms of the IRBA, the South African Regulators Inspections Report, they've indicated that as a result of the reasons that I've already mentioned, they are going to pay a lot more attention to this in future. They have been paying a lot of attention in the last year or two, but we can expect a lot more attention paid by regulators, not only in South Africa but worldwide. They're asking the question, why can a certain client not be acceptable for a certain auditor or an audit network or a group, but another group is more than happy to take them on? It is quite possible that there are good reasons for that, but it might be that we just didn't think properly about it. So I'm going to go through the changes in terms of the new quality management standards. And the changes that we have are, I'm going to look at the new requirements. There's really only two new requirements that we look at. And then in terms of the risk assessment process, the new quality management standard sets out three or so different risks that we have to look at. First of all, in terms of new requirements, what the new standard is saying is that we have to make sure that our financial and operational priorities are appropriate in terms of the risk and the quality considerations. What we mean by that is there's always a spectrum. On the one end, you try to be profitable. We have to make a living out of auditing, and we have to make sure that we get clients and that we keep growing and we get bigger clients and our clients keep growing. That's the one side, that's the operational pressure. And on the other side, there's quality pressure. If you have to not do a client simply because you are not certain about it, then we are probably going to end up with no clients these days. So we have to make sure that our decisions are not inappropriately influenced by financial and operational priorities. We have to make sure that we're on the right place in that spectrum. And then also, very important is the firm needs to determine whether it has access to the right information or persons. I will refer to that later again, but it is very important. I have found in practice to be a huge red flag, a big concern. If you're doing an engagement locally, whether it be an audit or consulting or tax work or whatever, and you don't have access to the correct persons. Who are the correct persons? It depends on what you're doing, but at some stage you should obviously have some access to those charged with governance, being the directors or the audit committee or someone like that. And if you don't have access to them, then that is a clear red flag that you have to think really carefully about. If there's no access, or the access is ineffective, or the client doesn't seem to care too much about it, then that is a red flag that we have to pay attention to. So in terms of the standard, those are the two new requirements that have come in. As you know, the standard works on a process where you do your risk assessment first. So first you have to look at what the risks are in terms of what can go wrong, what are the quality objectives, and then you have to respond to it. And the standard includes certain responses. ISQM1 requires us to set certain quality objectives. the quality objectives that are set out in ISQM1 are obviously not all the quality objectives we should have, but this is at least a minimum that we should have. First of all, we should have as an objective of our quality management system that we must make sure that we always obtain sufficient appropriate information about a few things. You need to understand what the nature and circumstances of the engagement is. What is the client expecting you to do? And why? Under what circumstances? What is the client going to do with the information that you're going to give them, or the report that you're going to give them, or the assurance that you provide? What is the client going to do with it? And then also, you need to make sure that you obtain evidence about, or information about, the client's integrity and values. Those softer things, things that sometimes may have resulted in the previous auditor not taking on the engagement or resigning from the engagement. This is your responsibility. The firm must set an objective that the firm will make sure we will always get that information first before we make a decision. And then also, let's look at the firm itself. Is the firm able to perform this work? Now that we've looked at the client and we are happy that we want to be associated with this client, are we able to perform the work at the appropriate level? Meaning, do we have the necessary resources? Maybe it's in a specialist industry. Maybe it is an industry that we have taken a decision not to get involved in because we don't have the resources. Maybe the client is just simply too big or geographically spread out too far for us to handle. Is it the sort of client that we can handle? And then the point that I mentioned already is, will you be able to get the appropriate information, and will you be able to speak to the right people about getting the information and also sharing from our side? Because remember, it's a two-way street. And back to the firm's financial and operational policies, we should have as a quality management objective that as a firm, we will make sure that our operational and financial policies do not contradict our commitment to quality. So we have a commitment to quality and we have a commitment to grow. Those two must not contradict each other. And then obviously once you've made these decisions, or once you have obtained the necessary assessment information, the firm must respond appropriately. The firm must decide if we're going to take on this client or not, or if we are going to take on this client, are there going to be certain safeguards that we need to implement? And obviously, as always, judgment is important. Judgment is critical. In these new standards, judgment is probably even more important than ever. And it's very important that whatever judgments you make are sound and they are supported by sound reasoning and obviously documented. Judgment is only as good as the considerations that went into it. You can't just say you exercised your professional judgment, but you do not have anything to base it on. So that's the objectives that we should set for ourselves. Just a couple of tips, things that we have picked up from practice that you might want to consider when you look at a client. These are things, maybe let's call it red flags, or maybe some pointers that you might want to consider. A new client, how did the client get to you? If a client gets to you by an existing client referring it to you, so the client has been with you for many years, you know the client, you know the background, you know its network, you know its reputation. If that client then refers someone to you, it's unlikely that you're going to have a problem because you know that obviously the relationship is at stake. Whereas if you get a client just phoning you, as we say, off the street, or they picked you up in a telephone directory, there's obviously a bit more risk because you need to find out a little bit more about the client. Do we insist on referrals? You can't always insist on referrals, maybe it's sensitive. Also look at the financial reporting framework. Generally, if the framework is International Financial Reporting Standards or IFRS for SMEs, not a problem because we know what it is, it's very well established. But if there are some frameworks that maybe we are not familiar with it, very specialized industry, we're not familiar with the framework, or maybe the framework isn't so well defined. The client does what is done in the industry, and what is generally done in the industry is not so well defined. Everyone doesn't quite understand it. Then you might think twice before you accept that client. Are you going to be able to perform the work in accordance with a framework that you don't really know what the framework is going to be? Are you going to be able to report in accordance with the framework and you don't really know exactly what it is? Do we accept any financial condition? I think you will know, most of the viewers will know from experience that the clients that are in financial trouble are often the ones that give rise to the biggest risks and the biggest challenges on engagements. It's not a hard and fast rule because especially in today's economic climate, there are lots of very good businesses that have fallen on hard times. Maybe the economy is turned against them, maybe the technology has fallen behind, there could be an unforeseen claim against them or something like that. So there could be very good reasons. But there is a line where the clients are in so much financial pressure that they start passing that pressure onto their financial advisors in terms of calls that we have to make, in terms of going concern, maybe struggling to recover our fees. So maybe as a firm you could set guidelines for your partners as to would we be able to accept any financial condition, or is there a certain gearing ratio that we wouldn't accept? Think twice, consult, whatever. Are there any industries or sectors that you avoid? Maybe because they are high risk and you don't have an appetite for that risk, but maybe simply because they are specialized. You have to have a certain amount of specialization to make any industry work. It is not possible to be a jack of all trades. So maybe there is an industry that we decided to avoid. Maybe not because it's specialized, but because it's very high risk. We don't want that risk. So there could be different reasons why we want to avoid certain industries. What about tax conditions? If they are currently under investigation by tax authorities, be it for VAT or payroll tax, or maybe they've fallen in arrears with tax payments or some tax compliance issues, reputational issues. Some of these issues we can sort out. That's the business. We are in the business of sorting out problems for clients. We are proud of it and we can do it well. So I'm not saying stay away from any clients with problems, but there could be some problems that you can just maybe decide as a firm, no, we're not going to get involved at. It just puts too much pressure on our resources and puts too much pressure on our ability to perform a high quality engagement. What about the state of the accounting records? Again, we can sort problems out. That's our business. As accountants, as auditors, we are maybe not so much in the business of sorting out problems, but when you do related services, when you draft financial statements, perform tax compliance work, we are in the business of helping clients to correct things. We are not scared of that. But then also we must realize that if the accounting records are in a terrible condition, in a condition where the client is really expecting you to take responsibility for what they should have done in the first place, then there could be a point where we say, no, we can't do this engagement, we would be better off walking away from it, or maybe even referring the client to someone who can fix it for them, give them some time to correct it, and then come back and revisit the engagement. What about the people that are going to be working on this engagement? The partner, the senior management, anyone else involved in the engagement. Do they have the appropriate skills, expertise, time? Again, when I talk about skills, we can learn. We are in a profession of lifelong learning. What I knew yesterday is definitely not going to be sufficient for what I'm going to do tomorrow. And the clients that I'm going to do the day after tomorrow, I'm going to have to learn a little bit before I can do that. And that's fine, that's acceptable. But there is a point where your skills and experience just cannot be sufficient. Nothing makes up for good experience. And there's a point where you have to say to a client, and there's no shame in saying to a client, our firm just doesn't have the capability. Or as a partner, I don't think I'm the appropriate person to service you. I can refer you to another partner, or I can refer you to a colleague, or I can refer you to a different business, but I don't think I can do the best service. That could possibly be because of existing conflicts. Maybe I have clients that are in the same industry that have the same close relationship with me, and this prospective client doesn't appreciate the fact that I already have a close relationship with their competitors. Some clients appreciate it. It could be a good thing counting in your favor if you work with clients in different industries. That could help you a lot because it will assist you in gaining some specialized experience, and that will give you some credibility. Do you have time? If all your clients fall in the same financial year end, then there's going to be a point when you're physically just not able to service all of those clients. And then you have to call it. You have to say, sorry, I can't do it. If you want me to do it, I can do it 6 months later, or I can refer you to someone else. But I don't think that I will be able to perform the appropriate level of quality of service and provide you with the appropriate quality of service. And then I have to emphasize this again because this is such a red flag to me. I've mentioned it twice again. But do we have access to the right persons? We find maybe a company is a multinational organization, and the company that we are doing, the little entity that we are responsible for, simply doesn't get a lot of attention from the international management? Well, then make sure that they understand what we are doing and they understand the conditions that we are operating under. Or maybe management has always thought this is something that the accountant does for us or that the auditor does for us. The directors are not going to get involved. Well, the directors have to get involved. They are those charged with governance. So the standards, and that goes in the auditing standards, that goes in the quality control, quality management standards, the standards are very specific about the fact that we have to have effective communication at the appropriate levels, and that level will probably include those charged with governance. I cannot emphasize that enough. If you have concerns about that, then we have to look further. So those are just a couple of pointers that we have to consider, or that we can consider. You might have to add to that, might be able to add to it for your own conditions and your own firm and your own preferences. Some of them might not be applicable, but I hope that this assists you in considering your client relationships. Thank you for your attention.